Welcome to EduTap and welcome to today's Finance 360-degree session. Now, this session is going to be important for all of you as we are going to discuss 4 very important finance current affairs in this particular session, okay? And these announcements have been made under the RBI Press Releases. So, let's discuss that what are these 4 finance current affairs that are very important. Major updates have been brought by the Reserve Bank of India that has been announced by the RBI. So now let's get started without any delay, and let me inform you that what we are going to discuss in today's session. So first of all, we are going to discuss about the launch of the Financial Literacy Week. So this is very important, the Financial Literacy Week. We will discuss about it, that since when it was launched, as well as this is important as you can use it in your answer writing. Okay, if a question is coming on financial inclusion, the financial literacy, if a question is coming in regards to the steps that have been taken by the regulators to boost the convenience of the customers or the literacy of the customers in terms of the financial system. So this is very important step. Then we will discuss about the RBI announces the measure for the urban cooperative banks, the limits, like there are certain discussions that have been taken for the Urban Cooperative Bank, and recently the Saksham mission Saksham has been launched. So we will discuss that what is this. Then we are also going to discuss about the limit for the collateral free loans that have been increased for the micro small enterprises. And another important discussion that we are going to have is on the voluntary retention route, for which there are changes that have been brought, and the voluntary retention route has been brought or subsumed under the general route. So what are the different limits that we will discuss? So all of these articles, they are the small articles, but they have some important key points that you have to keep in mind. So let's get started, and first of all, give me a thumbs up. I hope I'm clearly audible and visible and there is no problem that is coming. Good morning, Ria. Good morning, everyone. Thank you for joining first of all, and let's get started. So before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel in which you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So you can download the PDF of the session from the Telegram channel of EduTap. Now let's start with the first article for today, that is RBI launches the Financial Literacy Week 2026. So the Reserve Bank has been conducting the Financial Literacy Week ever since the 2016. So every year the Financial Literacy Week is conducted since 2016 to promote the financial literacy, Now the Governor Shri Sanjay Manotra launched the 11th edition. So this is the 11th edition of the Financial Literacy Week that has been launched, and the theme for this Financial Literacy Week is KYC. Know your customer, सुरक्षित banking की ओर पहला कदम. So KYC is your first step to safe banking. KYC, your first step to safe banking. Okay. So KYC basically it helps the banks to identify the customers, so that the frauds can be prevented, the money laundering can be prevented, and the misuse of accounts can be prevented. So basically to identify that actually the customers on whose name the account is being opened or the loan is being taken, that is the same person who is opening the account, who is taking the loan, so that there is no misuse of the accounts, or there is no fraud, or there is no money laundering that is happening. Okay, so the KYC it is the first step to safe banking. It provides the idea to the banks that this is the customer, and the KYC it helps the bank to identify the customer, okay, to prevent the frauds and such, as well as the simplified KYC procedures. It makes the KYC process more efficient and easy to understand for the small account holders, for the small micro enterprises and such, okay, for the small enterprises, micro enterprises. So if we have the simplified KYC procedures, if we have the central KYC registry, so the KYC becomes efficient and it is better for the small account holders, the small enterprises, the medium enterprises. So this is the idea. So KYC is very, very important in the banking structure. Now the governor has emphasized the importance of KYC for safe, secure and inclusive banking. So banks were urged to use the Financial Literacy Week to spread the awareness about the KYC and re-KYC procedure. So it's not like that you are opening the account, then only you will have to do the KYC, and after that there is no need for KYC. No, after every regular interval there is the re-KYC that happens, so that it is identified that actually still you are using the account or not. Okay. Now as well as the banks were urged to use the Financial Literacy Week to highlight the role of Central KYC Records Registry, where the records are maintained regarding the KYC, in simplifying the customer onboarding and bringing the simplified procedures so that the customer onboarding can happen without any much problem. Educate the customers. So banks are also responsible for educating the customers against KYC regulated frauds and account misuse, okay, and informing that why the KYC is so important. So now the Financial Literacy Week, it is usually conducted in February only. So now also it is conducted in February. RBI will conduct multimedia awareness campaigns on the Financial Literacy Week theme, and the banks have also been advised and requested to actively disseminate information and promote customer awareness. So this was the first article that we have discussed. Remember the theme for the KYC, your first step, remember the theme for the Financial Literacy Week, that is KYC, your first step to safe banking. And the Financial Literacy Week is usually conducted in February only, and the banks have also been requested to undertake the different things, okay. So this is the idea. Now moving forward with the second article, the review of the voluntary retention route for FPI investment in debt instruments, okay. So the foreign portfolio investors, first of all, I hope you know that the foreign portfolio investors, they invest in the financial products, in the financial instruments, in the financial market of our country, of India, right? So foreign portfolio investors, they are investing in the financial products, the financial instruments in the financial market of our country. So foreign portfolio investors, they invest in the debt instruments, they invest in the corporate debt securities, they invest in the central debt securities, they invest in the state development loans or the state debt securities also. So debt instruments are basically the instruments through which the central government or the state government or the corporates are raising the funds, they are raising the debt, okay. So debt instruments are, or the debt securities, they are the instruments, they are the financial instruments through which the central government or the state government or the corporates, they are raising the funds, they are raising the debt. So foreign portfolio investors, they can invest in the debt instruments, they can invest in the corporate debt securities, they can invest in the state development loans or the state debt securities, they can invest in the corporate debt securities also. So the foreign portfolio investors, they have access to the debt instruments in the financial market of India. Now there is a route, that is voluntary retention route, that is provided to the foreign portfolio investors to invest in the debt instruments. What is this voluntary retention route? So this enables the foreign portfolio investors to invest in the Indian debt markets for a longer frame of time. So that means the foreign portfolio investors that are investing in the that are investing through the voluntary retention route, they are investing for a longer time period, okay. So they have the minimum retention period, they have to follow the minimum retention period of 3 years, okay, or it can be changed as advised by the RBI, but currently it is 3 years or as advised by the RBI. So this is the idea that if the foreign portfolio investors, they are investing in the debt instruments in the financial market of our country, they are investing in the corporate debt securities or central government securities or state government securities through the voluntary retention route, then they have to keep the securities for a time period, okay, for a minimum retention period of 3 years. Now why the foreign portfolio investors would want to keep the debt instruments for the 3 years time period? Why not just buy it and sell it later on when the benefit has been taken or when the returns are good? So usually the foreign portfolio investors, they invest through the voluntary retention route because there are benefits also that are provided to these investors. They get the exemptions from certain macro prudential limits, okay, as well as they also get the relaxed norms. They also get certain relaxed norms. They have to follow the relaxed norms. So this is the idea that voluntary retention route, it is a scheme introduced by the RBI to facilitate long-term investment by foreign portfolio investors in the Indian debt market, where the foreign portfolio investors are committing to keep the securities for a minimum retention period of 3 years. So minimum lock-in period of 3 years for investments. If the foreign portfolio investor is buying the corporate government security, corporate debt security, or central government security, or state government security, so they will have to hold these securities for 3 years. They cannot just immediately sell it in a week or in a month and such. Okay, so they have the minimum retention period of 3 years. Voluntary commitment. So investors can voluntarily commit to retain a minimum percentage of their investment for a specified period also, like they can commit to keep the investment for a longer period of time. That means, let's say this foreign portfolio investor has committed that whatever securities, whatever debt instrument this investor is buying, they will keep it for 5 years or for 6 years. So why they are committing for a longer period of time? Because they will get more exemptions, they will get more relaxations, as well as they will get the priority when the allocation or allotment is happening. Okay, so they will get certain priority under this VRR route. So that is the idea. So investments under the VRR are exempt from certain regulatory limits and they have certain relaxed norms. So this is the idea about the VRR. Any confusion first of all? So VRR is a scheme of the Reserve Bank of India to facilitate the long-term investment in the Indian debt market from the foreign portfolio investors. And long-term investment means that there is a minimum retention period. If the foreign portfolio investors are investing under the VRR route, they have to retain the debt securities that they have purchased, the debt instruments that they have purchased for a minimum period of 3 years, and they will get certain benefits. So the voluntary retention route was introduced by the RBI in March 2019 to provide an additional channel for investments by FPIs, foreign portfolio investors, with long-term investment interest in the Indian debt markets. So you can understand this is more safe also, because the because if there is any problem or any volatility that is coming in the foreign institutions or in the foreign markets, so the investment under the VRR cannot be taken out immediately, because in the VRR there is the minimum retention period. So this is also the safe kind of investment that is happening for India. It will be safer because immediately the money cannot be taken out by the foreign investors. So for India, this kind of investment is better, more stable. Okay. So over the years, RBI has been revising and refining the route, the voluntary retention route, to provide greater operational flexibility and ease of doing business. The VRR has been witnessing active investment by the foreign portfolio investors. Over 80% of the current investment limit of 2.5 lakh crore has been utilized. So the current investment limit under the VRR, there is the current investment limit of 2.5 lakh crore. Got it? So this is the idea. Now, why are we studying about the VRR? This is a static concept, right? So what has happened that the RBI has recently reviewed the voluntary retention route for FPI investment in debt instruments, and there are certain changes that have been brought in this voluntary retention route. So let's discuss these changes. So in the previous slide, we have just discussed that for the voluntary retention route, the current investment limit is 2.5 lakh crore. This limit has been removed because, see, there is a general route for the investors. There is a general route. Under the general route, the normal kind of foreign portfolio investments are happening. Okay, so foreign portfolio investors, if they want to invest without any minimum retention period or without any such kind of retention norms, so foreign portfolio investors in the normal conditions, they invest under the general route. Foreign portfolio investors, if they agree to retain their investment for a time period, they invest under the VRR. So there were different limits for the general route and for the VRR, because in the VRR there are relaxations that are provided, there are exemptions that are provided, but there is the minimum retention period. In the general route, there are no such relaxations or exemptions, and the investors have the freedom to take out their money whenever they want. There is no minimum retention period. So there is VRR, foreign portfolio investors, they can invest through the VRR or through the general route. So for the general route, there were different limits, and for the VRR there is different investment limit. The investment cap is different. Now it has been said on a review, it has been decided by the RBI that following changes will be taken into account in the VRR. So first change is that the investment limits under the VRR shall be subsumed under the investment limit for FPI investments under the general route. So these are the limits, and these limits are usually announced on the yearly basis. So these are the limits under the general route. Now it has been said that rather than having different limits for VRR and general route, now there will only be one limit that will be followed by for the VRR also. So the general route limits are the final limits and the VRR investment limits have been removed. So that means the investment limits under the VRR, they have been subsumed under the investment limit for FPI investment under the general route. So these are the limits. Now for the VRR also, these limits will be followed, and this is the limit for the general route. So for the general route, I hope you have understood that VRR is the investment. Foreign portfolio investors are investing in the debt instrument for a time period. So there is a minimum retention period of 3 years or as specified by the RBI. And the foreign portfolio investors, because they are holding the investment for a time period, so they get certain relaxations. While the general route, in this, the FPIs can invest in the debt instruments without any limit in the retention period, okay, without any retention period norm. And they also, because there is no retention period that has been defined, so there is no relaxation that is provided, okay. That is the idea. Now for the general routes, whatever the limits are, that will be followed for the VRR. The same like the general route limit, under this limit only the VRR is also coming. That is the idea. So the investment limits under the VRR shall be subsumed under the investment limit for FPI investments under the general route. So this is the idea. So all investments through the VRR, all the investment that is happening through the VRR in the central government securities, in the state government debt securities, in the corporate debt securities shall be reckoned within the respective investment limit under the general route. So this is the idea. That this is the change that has been brought. Investment limits under the VRR, it has been subsumed under the investment limit. So VRR has been subsumed under the investment limit for FPI investment. Now for general route, what are the limits? So this is the idea that for the general route, central government securities including the treasury bills, they have the limit of 6% of the outstanding stock of central government securities, okay, other than those included in the specified securities under the fully accessible route. So basically 6% of the outstanding stock of the central government securities, this is the limit for the general route for the central government securities. For the state government securities, 2% of the outstanding stock of the state government securities. Corporate debt securities limit is, the foreign portfolio investment limit is 15% of the outstanding stock of corporate bonds. So these are the general route limits. These are the general route limits. And the investment limits under the VRR, whatever the investment limits are under the VRR, they shall be subsumed, they shall be included, and or they shall be included, or they shall be conducted under the investment limit of FPI investment under the general route. That is the basic idea. Now, next is FPI. So I hope this is clear that the VRR investment limits have been subsumed under the investment limit for FPI investment under the general route. Now the final limits are these. These are the final limits. And the VRR limits are also under these limits only. Now, the FPIs that have availed retention periods, now the next change that has happened is that the FPIs, they have availed retention periods longer than the minimum retention period. So if there are the FPIs that are investing in the debt instruments under the VRR and they are committing to keep their money for a longer period of time in India as compared to minimum retention route, that is 3 years. So the FPIs are committing to keep their money in India for 6 years for the debt instruments or 5 years, that is longer than the minimum retention route. So now the FPIs, they will have the freedom or they will have the relaxation that after the minimum retention period is finished, they can take out part of their investment. They can like sell off or they can get back part of their investment. Okay. So this is the idea that FPIs that had availed the retention period longer than the minimum retention period, then they shall have the option that after the minimum retention period is finished, they had availed for a longer retention period, but when the minimum retention period is finished, the FPIs now will have the option to liquidate their portfolio fully or partially, and they can exit the VRR also. That means if they have, let's say, initially they announced or they committed that they will keep they will keep their investment in the debt instruments for a 6-year time period. Okay, but now after the 3-year time period, if they want to take out their money, they can take out their money. So that is the idea. So this is a kind of relaxation that is provided, because some investors, they might think that they want to keep the money for 5 years, 6 years in India, but if in certain volatility kind of situation or in certain distress kind of situation, if the investors want to take out their money, they should be able to. So that is why the RBI has allowed this. So FPIs that have availed the retention period longer than the minimum retention period, they shall have the option of liquidating their portfolio. They shall have the option of liquidating their portfolio fully or partly and exit the VRR after the end of the minimum retention period. Correct, Ria. So correct. So the VRR limits, they are subsumed under the general route. So that means these are the limits that will be followed. Chalo. Now these directions, they shall be applicable, they shall be in force with effect from April 1, 2026. So that is the idea. Okay. So these directions shall come into force with effect from April 1, 2026. Now Mission Saksham, capacity building for urban cooperative bank sector. So what has happened? See, primary urban cooperative banks, they are present at the grassroots level. Okay. So primary urban cooperative banks, they are present at the grassroots level. They are having more community linkages, okay, and they have more access to the small borrowers or the small account holders. They have more access to the small enterprises and such. So basically the primary urban cooperative banks, they operate at the grassroots level, and they have strong local community linkages. So they are vital institutions for promoting financial inclusion and serving the unbanked areas, because they operate at the grassroots level and they have the strong local community linkages. So they are the vital institutions for promoting the financial inclusion and serving the unbanked areas, securing their next phase of growth. So for the next phase of their growth, the RBI has decided that there should be the launch of Mission Saksham. So to serve this objective, that securing their next phase of growth, this would depend upon developing stronger skills and competencies. So if the primary urban cooperative banks have to be further developed, stronger skills, stronger competencies will be required, along with the technical capabilities and operational resilience in them. To serve this objective, to secure the next phase of growth for the urban cooperative banks, the Reserve Bank will soon be launching Mission Saksham. So Saksham is Sehkari Bank Kshamta Nirman. Okay. So Sehkari Bank Kshamta Nirman. So this is Mission Saksham. This is a sector-wide capacity building and certification framework where the skill set will be improved for the employees of the primary urban cooperative banks. Okay. So vocational training, the training will be provided to the employees of the primary urban cooperative bank, so that the skill set can be improved of the employees. So this is the idea. So the capacity building of the sector would be implemented through a large number of physical training programs, as well as a scalable learning platform that will also be developed to cover over 1.40 lakh participants across all the functions. The Reserve Bank shall endeavor to conduct these training programs at locations close to participating UCBs. So the Reserve Bank shall endeavor to conduct these training programs at locations close to the participating UCB, so that the employees can easily access these training programs with content delivery in regional languages to the extent feasible, and the mission will be pursued in partnership with the umbrella organization of UCBs and national state federations. Okay, so this is the idea about the Mission Saksham, that is Sehkari Bank Kshamta Nirman. Now coming to the last article for today, that is enhancement in collateral free loan limit from 10 lakh to 20 lakh. So with a view to facilitate improved access to formal credit to the micro and small enterprises, and to support the entrepreneurial activity and strengthen the last mile credit delivery for the micro and small enterprises with limited collateral. Now these micro and small enterprises, they have limited collateral, they have limited assets. So it has been decided to enhance the limit of collateral free loans. So before, the limit of collateral free loans was 10 lakh for the micro and small enterprises, but now the limit of collateral free loans has been increased to 20 lakh for the micro and small enterprises. So micro and small enterprises, enterprise can get up to 20 lakh of the loan that will be collateral free. Now the above provisions shall be applicable to all the loans to MSE borrowers sanctioned or renewed on or after April 1, 2026. Okay, so this is the idea. Any confusion anyone has? Kindly tell me. Any confusion anyone? No confusion? No, clear. Okay, nice. Yes, just here there was a question from Ria. So remember that the VRR, these limits will be followed for the VRR. So now there are no separate limits as such. The VRR limit of the 2.5 lakh crore. So this is not the limit. And now the investment limit under the VRR shall be subsumed under the investment limit for FPI investment under the general route. That basically means that the general route limits will be followed for the VRR. Okay, and VRR investment will be categorized under the general rule for the understanding of the limits, or for the limits, the VRR investment limits are under the general route limits. Okay, so this is the idea. Now there are no separate limits for the VRR that will be required. Now this is the first question. I hope this you can easily answer. The 11th edition of Financial Literacy Week 2026 launched by the Governor Shri Sanjay Manotra was based on which theme? So this is a homework question. I hope you will be easily able to answer this question. Now the second question is that the Reserve Bank's mission Saksham, launched for capacity building of Urban Cooperative Bank, stands for. So this Saksham, the mission Saksham, it stands for what? सहकारी आर्थिक क्षेत्र शक्ति मिशन, सहकारी स्किल हार्मनी एंड मैनेजमेंट स्ट्रेंथनिंग एंड नॉलेज शेयरिंग फॉर होलिस्टिक एडवांसमेंट ऑफ मार्केट, सहकारी बैंक क्षमता निर्माण, सिस्टमैटिक असेसमेंट ऑफ नॉलेज स्किल्स एंड ह्यूमन asset management. So which of the following is the mission Saksham? That you have to understand, or that you have to answer. Now the last question is very easy directly, that the collateral free loan limits have been increased from 10 lakh to what? To 15 lakhs, 20 lakhs, 25 lakh, 30 lakh, 12 lakhs. What is the new limit? So I hope you will be easily able to answer these questions. And this is it for today. Thank you everyone. Thank you for joining the session. I hope you enjoyed the session, and let's meet in the next session now on Tuesday. So the sessions for Finance 360 are happening on Tuesday and Thursday at 10 a.m. Okay. So thank you everyone. Thank you for joining. See you in the next session.